Time flies fast in the rate world. This week, we're already at it again. As you're gonna watch this video that's gonna come out on Wednesday, well, the ADP report will already probably come out. And then we have Jobs Friday. We got a lot of Fed officials talking. But on this video, I really wanted to talk to you about one thing that I've been talking about for many, many years that typically is from a range of 1.8 to 2%. It got all the way to over 3%. And that number is at the lowest level this year, but it is at the lowest level in many years. And folks, we are talking about mortgage spread. And that is the difference between a 30-year fix and a 10-year treasury. In the mortgage industry, we watch the 10-year treasury. That is something we focus on. So when we wake up every day, if the 10-year treasury, let's say, has been sitting at 4% and it goes to 390 or it goes to 410, 390, better for rates. 410 means rates are going to go up. That is the barometer we watch daily to see. The spreads between the 10-year treasury and that is a function of what is going on in the market. That's a function of confidence. That's a function of money flowing into whether it's mortgage-backed securities. That's a confidence of what the Feds are doing, how the economy is moving. Are we on a straight line? It's a zigzag. Are we getting more clarity? So really, that means spreads have been improving, which is amazing for interest rates. If you go back, I think it was in 2023, where spreads were at an all-time of over 3%, mortgage interest rates would almost be 90 basis points worse. 90 worse, let's just round up to a point. So that means if you got quoted 6.375 on an interest rate, let's say this last week, it would be almost 7.375. That is how blown out the spreads were. That is how the confidence was down in the dumps. And folks, that is how much improvement we have got. So as much as you might be complaining and whining, and I get it, we all want rates to be lower, at least a little bit lower. We'd love to see them in the 5s. We have gotten a tremendous pullback and some tremendous help with the mortgage spreads this year. Oh, by the way, if we have never met, my name is Kenny Simpson. I focus on 1 to 4 unit financing. To age myself, I've been doing that about 20 years, funded over 5,000 customers, funded $1 billion of loans. And whether you're first-time home buyer, veteran, or sophisticated self-employed person that thinks you cannot get qualified for a mortgage, or you're just a veteran real estate investor, whether you fix and flip to build, have a real estate portfolio, need help with, need financing, need to figure some things out, well, I can help. So it's not just me, I have a team. So anything I can do to help, please reach out. Would love to chat. You can call me, text me, email me, or come by my lovely office, which I'm shooting in right now. But anyways, I appreciate you guys watching, and I film content like this. Yes, it takes time, it takes money, it takes energy. I've been doing this a long time. Why do I do it? Because I want to educate you. I want you to understand what is going on in the market. I want to break down some stuff that sounds like a bunch of mumbo jumbo, maybe like mortgage spreads, so that way you understand what's going on, how it can help you, and also I'd love to make rates great again. Anyways, so one of my new hats add to the collection. That'd be fun. But mortgage spreads. So mortgage spreads are at 215 to anywhere range. The 50-year average ranges, they've gotten blown out before after the 2008 crisis. Obviously, in times where rates are really, really low, where that means the Feds are coming in buying mortgage-backed securities, putting on that printing press, they can come down, but they typically live between 160 and 180. So if we're at 215 today, let's just say, we could still see, even if we land at 2%, even if we land at 180, we could see some significant still rate changes. So we might have anywhere from a quarter to half a point in rate improvement still ahead of us just with that spread. So if that 10-year treasury does make it around 385, 390, if we're so lucky, we're gonna have to wait for more cuts, we're gonna have to wait for more data. That would help this whole game out altogether. And the reason why I really wanted to make this video is because spreads, it's not just about the spreads, it's signaling where things are going, folks. And that's really what I want to make this video about, because look, spreads have been elevated. So if you go back when we had to jack the rates up to slow the economy down, which it did, but now we're bringing rates back down, and now we're getting it to a point where they're going to start potentially bringing rates down to the opposite way, where it'll have more of a dramatic effect on helping real estate rather than slowing it, on helping small businesses rather than slowing, on helping the consumer rather than slowing you. And so when you see spreads come down, that means there's confidence, that means there's stability, and that is a very, very good sign overall for the real estate market, for rates, and in general. So I'm happy to be shooting this video finally, because we've been waiting for these damn spreads to come down. It's just one feather in the cap, one check off the box of something that means we're headed in the right direction. I know, again, I talk about this over and over and over again, but it's something that is on top of your mind, because every time I talk to somebody, they kind of say, Kenny, I know you can't predict. I know you don't know. I know you'd be guessing. Should I refi now? Should I wait? Will rates go down? Should I wait? And folks, I get it. This is the common denominator. It's the common question, and it's the common conversation I'm having. I'm sure it's the one you're having with maybe some of you in real estate with, maybe you or your husband, your wife, a partner, maybe it's on your investment property, whatever it is. All I can tell you is what I'm seeing out there right now is there are a lot of people that, yes, are refinancing because they can definitely take advantage of it. Maybe they have rates in the 7s and it's this rate coming down. It's making a big difference. But there's also a lot of people where it just doesn't quite make sense yet. Maybe it's a 3/8, maybe it's a half point improvement. They're like, well, if rates come down another half a point in 6 months, 8 months, 12 months, whatever it is, I would rather wait. I'm okay here. I'm not being financially burdened. And what I would tell you is that nobody can tell you what to do, but if you saving $150 a month, $500 a month, $1,000 a month, $2,000 a month, $250 a month, whatever the number is, you have a number in your head that you need to save that would make sense for you, right? Cool. And so with that being said, if you can hit that number with a refi today, then do it. But remember, there might be costs associated, there might be something. So this is what I tell everybody. If you are going to refi today and you know yourself, you're going to refi, your rates came down and you think rates are going to come down in 12 to 24 months, whatever your range is. Keep in mind, if you pay points, if you pay closing costs, that's getting added to your mortgage. That is a cost. If you're going to refi in a year, even if you're saving $500 a month and it costs you $15,000 in closing costs, you're not going to make it up. My advice to you, if you can do at least a no point and a minimal cost loan or a no point and almost a no cost loan, that is going to be huge for you, because when you go do that next refi, this one's almost free. The next one maybe you'll pay for because you want that lower rate. Try to do that. Try to land in that bucket. And as far as rates coming down, nobody knows. The only thing I can keep telling everybody is that if the data continues to slow and get worse, that means rates will move faster downward. When Jerome Powell's out in May, I think you're going to have more Fed officials that are in line with the administration's outlook, or they will maybe be looking at data different, or they'll just be more aggressive with rates cuts because they look at things differently. Look, there's economists, there's politicians, there's people in the White House, there's people that report on this stuff. There's people in the real estate market. There's all types of people out there, right? That have, we could cut rates, we could not cut rates. There's all these opinions. But look, at the end of the day, if we went down 100 basis points in rate, is this really going to impact the market? Is it going to jolt the economy? Is it going to push up inflation? You know what? Nobody knows. We just don't know. So if we cut 100 basis points from where we are now, or 125, which seems to be the number, we won't know till we get there if that really does cause inflation or does something to where we need to pull back or slow things down. So if they cut 100 basis points, that is not Fed's fund rate at 0. There's still room to go. There's still bullets in the gun. There's still gas in the tank. And so with that being said, that's what I keep telling everybody. It seems that they wanted to cut around 100 to 150 basis points. We just cut a quarter, so maybe there's 100 to 125 left. If we did more, that means we have more problems in the economy than we thought. If we do less, that means the job market, inflation, the economy is doing better and we don't need to. But if we hit that number, let's just logically say they cut 150 basis points, 125 more, that should or potentially bring interest rates down about that much, right? So let's say the spreads, as we talked about in the beginning of this video, can come down another, let's just call it 30 basis points, okay? We'll say 30 basis points just to pick a number. That would mean you'd probably put the 30-year fixed interest rate with no points somewhere around 6%. I'm just using rough general numbers here, folks. I don't have any exact scenario. Your scenario could be higher, your scenario could possibly be lower. That isn't like conventional. On a Fannie, Freddie, FHA, that would definitely start putting you into the mid to upper 5s. But then if that 10-year Treasury comes down, right, from them cutting, another 50 basis points, let's say. So let's say it lands, I don't know exactly where the 10-year treasury is at today. Let's say the 10-year treasury goes down to 380 and we drop 40 basis points. That would mean you're looking at a no point 30-year fixed mortgage around 5.65. Let's just pick that number, okay? Not bad. That means you're probably looking at FHA VA mortgage somewhere in the low 5. That means you're probably looking at commercial rates in the low 5s to upper to mid 4 range, because right now there's commercial rates that are in the low 5s. So if you drop spreads down, things like that. So again, that's what I'm trying to tell everybody. I think when this lands, when they feel like they cut and we get here, whether it sticks, whether it stays or not, we just don't know, because we don't know till we get there. My prediction and what we're hearing and what we're seeing is the market, people want to get that 30-year fixed rate at no points, probably somewhere around 5.5. If you're paying points, probably somewhere in the low 5s. You're going to get FHA VA loans somewhere in the upper 4s. You'll have maybe some ARM rates, some jumbo rates, things like that. You could buy down things like that, probably in the low 5s, maybe some upper 4 rates, maybe some other ARM rates in the 4s. That's probably where we're going to land. I don't know exactly when. I wish I know when, because I would tell you right now, but I don't know. And so that's what I would plan on for. Could it not get there? Absolutely. Could it go further? Absolutely. It just depends on the data, depends on who's going to get elected as a Fed official, it depends on how aggressive they are, and depends on if they start changing their policies, changing their thoughts, saying, okay, well, we were at 2% inflation, but we're okay to live with 3%, and 3% is the new target, and we don't care about 2%, we're going to throw it out the window. That might change it. Folks, there's many things that can change. The 10-year treasury, look, at the refi boom was around 150, okay? I'm not saying it's going to get there, but the 10-year treasury is at 420. The 10-year treasury, if it just went down to 350, the rates would be lower than I'm talking about now. That's if the spreads improve. So I know everyone wants to keep talking about rates, what's going to happen. And so I really think that you are going to see the most aggressive rate moves, the most aggressive rate actions, the most aggressive rate talks once you know who the new Fed official is, once you confirm them in office and Powell is out, and once this new Fed official and this new regime and the new Fed official players come in, where they really think the market is economy and stuff like that. The good news is, by the time this new person comes in May, we will have probably another 6 to 7 months of data that will really tell us where things are at, whether it's inflation, jobs markets, GDP, growth, all that stuff. So stay tuned for more, as always. But if you are not in a rush to refi, I would say if you wait longer, there should be more benefit. If somebody is telling you that rates aren't going to go any lower and you should refi now, and they're trying to put, some type of pressure on you or gun to your head, and I'm hearing this stuff, and you should refi, you should do it now, that's not it. Will there be a point in time where I might be on this camera and be like, refi now, rates are great, like, do not, if you might get smoked, they might not be going further. Yes. When will we know that? Probably when we get a new Fed official in, we really understand their path, their trajectory, what their thoughts are, and all that stuff. Then we'll really be able to figure out where we think their bottom is. But like I mentioned before, the people that might get elected are talking 100 to 150 basis points cut. That would probably put us, like I said, somewhere in the rate range where we are. Rates in the 4s and to the 5s, depending on if it's conventional, jumbo, ARM, on the investment, FHA, VA, the whole thing, what your scenario is, that's where I think we're going to live. We need rates to get in the 5s to get real estate moving. And trust me, you drop rates 100 basis points, not only residential, commercial, small business, consumer, it's going to help a lot. It's going to be able, all these millions and millions of people can refi, millions of people can buy. $2 trillion, $4 trillion of commercial real estate's got to get refinanced. Just a huge thing. There's Treasury debt that needs to get refinanced. There's so many things and so many reasons to get those rates on. Look, and a lot of people think we should not lower rates and maybe think we should raise rates or keep rates or let the market do this. So we will see what happens. Anyways, and always, thanks for watching. If I can help, please reach out. You know how to get me. Reply back to an email, text me, email me, call me, stop by my office, DM me, whatever it may be. Anyways, appreciate you watching. Share this with somebody. We'll see you guys soon.